Hello everyone and welcome to another Zerodha Educate webinar. Today's webinar will be about exchange traded funds or ETFs. In the recent past, we are seeing increased adoption of ETFs. Having said that, these are very early days and a lot of retail investors still have a lot of misconceptions about ETFs, or they aren't aware of how they work and how to use them to build portfolios. From basically nothing, today the AUM of ETFs stands at 1.4 lakh crores and is impressive growth thanks to EPFO and the increasing awareness about the virtues of passive investing. Today we have with us Chintan Haria of ICICI Prudential Mutual Fund. Chintan is the head of product development and strategy at ICICI Prudential AMC. He is responsible for driving new and existing products and working closely with the respective teams to augment business growth. So we couldn't have picked anyone better to talk about this topic at hand. Over to you, Chintan.
Thank you. And to all the viewers, thank you for taking the time out. It's a new subject for many of you, and I would try to make it as simple as possible. As far as what is an ETF, ETF is nothing but a mutual fund which gets listed and traded on the stock exchange like a small stock. Now, if we see mutual funds, the benefits of mutual funds, which then obviously then flow on into ETFs, is the fact that mutual funds are diversified basket of stocks. So it is not a single stock, but maybe say 25, 30, 50 stocks. Which you can buy in a single go in a small basically amount itself. And when that gets listed on the stock exchange, it further gets basically broken into smaller units called ETF units, which you can buy for as low as say 140 rupees or 30 rupees or 40 rupees, depending on the price of the ETF itself. I'll just quickly go on to the basics of ETF, which is the slide in front of you. If we see what is an ETF, effectively, it is like an index fund wherein it tracks an index. What is an index? If you see there are index providers, which is basically Nifty Next 50, there is a Nifty Low Vol 30, Bank Nifty. There are all these indexes which are there, and on these indices, there are funds or mutual funds which are basically created, which gets listed on the stock exchange. This become ETF. So effectively, you get a participation in Nifty 50 or Nifty Next 50 through these ETFs. They basically track the index itself. Effectively, what is the biggest pull for ETFs is that it being passive funds. Along with the fact that it is passive funds, it is low cost itself. Cost itself for ETFs being lower, it makes it in the long run good for the investors, provided they can pick up the right product. So at all points of time, our belief is that advisors and the right advice is important for all investors. If you get the right advice and you are invested in the right product, it is a low cost product. It is in your favor itself. Also, ETFs, unlike the actively managed funds, have a lower turnover ratio. That is from the mutual fund side of it. If we see the ETF, it is traded on the stock exchange, it behaves like a stock itself. There is intraday trading. For example, if markets open 3% lower, if you want to take advantage of a fall in markets intraday, it is better to go and buy an ETF, because unlike a mutual fund, if you invest in a mutual fund, you get the day end NAV. In the ETF itself, you go on the exchange, you get the benefit of buying it intraday when the prices are 3% lower, and get the benefit of intraday price movements. The same way, if the markets are up and you want to sell intraday, you can sell the ETF unit intraday when the markets are high. You can obviously, like I said, buy in minimum order sizes or very small sizes. For example, the Nifty 50 ETF, if Nifty 50 ETF is trading at say 30 rupees or 40 rupees, effectively what you are getting is the entire 50 stocks available to you for as low as 30 to 40 rupees in a unit. You can multiply the units, you can buy as many units as you want. So effectively, it does not require big amounts of money with you to start participating in markets. You may be earning, you may be saving as low as say 100 rupees, 200 rupees, 500 rupees, and investing 100 rupees, 500 rupees. A drop in ocean over a long period of time makes basically the ocean much bigger. Similarly, bit by bit, when you save every month, you invest every month, you can create a larger pool of assets as the years go on. And the benefit of compounding will mean that your wealth creation happens in a big way. We have seen, like was mentioned in the introduction itself, that over the last 5 to 10 years, not just in India, even globally, the ETF AUMs have gone up very sharply. If you see the slide in front of you, the ETF assets actually have gone from a negligible, maybe $100, $200 billion 10, 15 years back to as high as $5 trillion. And very recently in US, the actively managed funds AUM has gone below the passively managed funds. In other words, the ETF AUM has gone up higher than the active AUM in US. That's obviously because of the fact that pension funds and large asset owners are investing in ETFs, and that has basically led to the higher AUM and higher acceptance of ETFs. Coming back to India itself, if we see the graph in front of us, there has been a massive rise, almost a 60% CAGR in the last 10 years, thanks to, of course, the pension industry being opened up in 2015 for investing in ETFs. And that has led to the AUM in ETFs reaching 1,40,000 crores. Our belief is that this trend is only going to grow up as financialization and the fact that the knowledge of ETFs is going to grow among everyone, and more people are participating in it. So the pension industry, of course, will keep on adding to the AUM. And that if you as an investor are also going to participate through the small case or otherwise in ETFs, you will be able to basically participate in the growth story of India through the ETFs in the Indian market. Just a brief on the product suite which is there available with us. This is obviously something wherein our belief is the more number of products on the passive side you have, the more number of choice that an investor has. You can pick and choose, or your advisor can help you pick and choose which ETF suits you well at different points of time. It could be sectoral ETFs like banking. It could be large cap ETFs like Nifty 50. It could be broad market indices like BSE 500, S&P BSE 500, or it could be gold ETF itself, which is giving you access into gold. Then, of course, there are government divestment ETFs as well, like Bharat 22 ETF. And if we see the concept of smart beta, which I'll probably briefly touch upon when we reach the three options, which I will show within small cases ETF, there is smart beta ETFs like NV20 and Nifty Global 30 itself, which are basically not market cap based indices. They are indices wherein the weightage is basically, or the stock selection is basically based on certain smart beta factors. It sounds a bit technical. I'll try and simplify it when we reach that particular stage. So what is small case? Coming to the discussion itself, what is small case? It is a combination. The small case is essentially a combination of 3 or 4 ETFs, maybe 5 ETFs, which are brought together, which you can buy at one go. And I'll obviously give a demonstration for making it easier for all of us to see how easy it is to execute on the Smallcase Zerodha platform. That based on certain parameters, a selection of ETFs are created, and then you as an investor can basically invest and buy into those, and also create SIPs for which recurring investments can happen in those. So I'll go on to the live demo itself on the Zerodha, smallcase.zerodha platform. So the URL for that is essentially, as you see, smallcase.zerodha.com. On the smallcase.zerodha.com, if you click on Discover, you will see, as we scroll along down, all collections. Within all collections, of course, there are many options. I'll come to the options of ICICI Prudential ETF, that is our offerings that are there. There have been 3 small cases which we have created, which we feel will fit along different use cases from an investor perspective. One is the diversified one, the other is the smart beta one, which is what we call the ICICI Prudential Smart, and the third one is ICICI Prudential Leaders. Just one line on each one of them, and then I'll probably show how easy it is to execute on the smallcase.zerodha platform. The diversified one provides basically exposure to various large cap, mid cap, gold ETF. So it's a combination of various market capitalizations. So from a long-term perspective, if you want to participate in every market category, including smart beta, the diversified has those options, and I'll show it later. Smart beta is essentially, like I said, those ETFs which are not necessarily based on purely market cap or the largest companies within a particular basket coming in. These are selected on the basis of either their return on equity or their most profitable companies or the low volatility companies. So I'll explain it when I reach there. And the leaders is essentially the large cap oriented ETFs. I'll start basically with the smart beta ones, which essentially is something wherein with as low, if you see the minimum investment level, with rupees 141, you are getting the benefit of investing in this proportion, which is in two ETFs, which is ICICI Prudential Nifty Low Vol 30 ETF 60% and NV20 40%. With just 141 to start with, you get an exposure to these two ETFs. What are these two ETFs? These two ETFs are essentially large cap oriented ETFs, and the low vol 30, as the name suggests, it's essentially a portfolio of 30 stocks chosen out of the top 100 Nifty stocks, which are the least volatile. Essentially, to put it in cricketing terms, if you see, a steady, consistent batsman in the long run does better. Similarly, low volatile stocks are nothing but steady, consistent stocks which have low volatility, and in the long run, basically, they may do well. NV20 is again based on certain price parameters. The portfolio is selected, and there are 20 stocks chosen out of the top Nifty 50 stocks. If I have to just execute it, I say buy. It has already picked up the live prices. Based on the live ETF prices, I need 141.34 to basically buy these two ETFs in the proportion of 60 and 40%. At the moment I say confirm amount, it is giving me the portfolio itself. What is it going to execute? It is going to execute both of these in one unit of each, and the SIP part of it. Very important that as we keep saving every month, we should invest every month. And when you're investing in this ETF, you can actually change the amount also, of course. This is something which I missed. You can increase the amount. If you have, say, 5,000 rupees to invest, you can just put 5,000 rupees over here and we are good to go. Again, with the 5,000 rupees, it calculates or recalculates and says 4968.19 is based on the live prices is what is required for the units which we buy. And along with that, it is giving the option that in the future date, on a 1 month later, you should be investing, say, 5,000 rupees more, because we've all seen the benefit of long-term investing via systematic investments can help us achieve our long-term goals of wealth creation. I say buy and start the SIP. I say confirm amount. It is placing the orders on the exchange. The orders are being placed on the exchange and the execution is done. You can view your investments, and this is how it will get shown. So it was as simple as that from a perspective of investments. That was on the smart beta one. I'll quickly speak about one sentence each on what the diversified ETF. We believe that from our perspective, if you can get a basket of these 7 or 8 together, you're investing in every market capitalization segment which is available. So we've carefully curated this combination of ETF investments so that in the long run, in each market segment, including, say, bank ETF, gold, mid-cap select, low vol 30, you get some exposure. And in the long run, when all of these kind of grow along with the Indian market, you get a participation into these. So with as low as around 1,700 rupees, you can get the benefit of investing across so many mutual funds. And similarly, you just say confirm amount, you can change the amount when you want, buy and start SIP, done. So it's very easy, it's very convenient. And from the perspective of the user or from your perspective as an investor, it becomes extremely easy to use the platform. So 2 transactions I've already shown. I'll not bore you with the third transaction, but I'd also probably like to explain the leaders portfolio in a minute. The leaders portfolio is essentially created for large caps. We've seen that large caps are nothing but blue chip companies, which in the long run have much stronger balance sheet, stronger brand strength, brand recall, and they tend to have less volatility and long-term stability as well. So with that, if you see these 4 in the proportion of 25, 25, 30, 20 are available, that is Nifty 50, Nifty Next 50, Nifty Low Vol 30 and NV20. So the benefit of market cap weighted indices plus smart beta in one go, and that too at as low as rupees 504. I'm not obviously going through the execution of the transaction. But essentially, friends, it is very easy. I urge all of you to basically start investing in ETFs. Um, in the long run, of course, it will help you with wealth creation. Don't invest in ETFs with the view of investing today and basically making money quickly and taking out after 6 months. Equity investing in general requires long-term horizon. When I say long-term horizon, because you are buying stocks and you are becoming essentially owners in those stocks, it is meant for 3 years, 5 years, 10 years, and even more. And the longer you keep equity, the better it is from your investment perspective. ETFs provide you the advantage of diversification. ETFs provide you the advantage of low cost. And in the case of Smallcase, if you see, it is giving you the advantage of investing in 3 or 4 of them carefully curated to meet your objective and in a very easy and transparent manner. Thank you for listening, and I hope all of you have a very, very good experience when you start investing and keep invested for the long run. India being a growth country, growth economy, one of the oases in the desert as far as globe is concerned, we believe that investing in equities through ETFs is something which will bring long-term wealth creation to all of you. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents